Emergency funds are a beautiful thing. They're there to provide you with instant access to cash should you need it, which gives you a certain level of financial peace and security that you just can't do without. Now, most people understand the need for an emergency fund, but a lot of people miss an opportunity when it comes to housing the emergency fund. Where should you actually keep your emergency fund? And that's what I want to talk about in today's video. Hello guys, Brad here from The Guided Investor. Welcome back to another video, and there's something a little bit different about my setup today. Now, I don't know if you can tell, I'll give you a hint, it's not that big ass plant in the background. I actually got myself a little lav mic in the hope that the audio sounds a little bit crisper for you guys. So let me know if it does, otherwise I've wasted a few bucks. Now, in my opinion, your emergency fund should be equal to roughly 3 months of your income. Now, if you're following a different plan, then your emergency fund's probably going to be somewhere between 3 and 6 months of expenses. But either way, it's quite a big lump sum of money. And if you have that money just sitting in a cash account, then for me, there's a missed opportunity there. You need to put that money to work as best you can while still keeping it 100% safe and 100% accessible. And the way you do that is going to depend on whether or not you have a mortgage. Now, if you do have a mortgage, then savings accounts are dead to you. You don't need them, you don't want them, because at the end of the day, you're never going to generate a better return after tax on a savings account as you can by using the money to reduce your mortgage. This is because banks work on a net interest margin, or a NIM. And the NIM is essentially just the difference between the interest rate that they lend money at and the interest they give you on deposits. In order for the banks to remain profitable, all they need to do is charge a higher interest rate on the money that they lend out than the interest rate on the money that they give in terms of deposits. And if they follow this rule, they will always remain profitable, and you as the customer will never generate a better return on a savings account than you will on a mortgage. In addition to the NIM, if you put your money into a savings account, you're gonna have to pay tax on any interest that you earn at your marginal tax rate. Whereas if you use the money to reduce the interest payable on your mortgage, that's essentially a tax-free return. So if you have an emergency fund, that emergency fund is going to be best used against your mortgage than it is sitting in a savings account. Now, there are a number of different ways that you can do this, and let's run through those now. The first way to do this is through an offset account. Now, if you don't know what an offset account is, then you really should, because offset accounts are a fantastic tool and they work like this. An offset account is like a standard cash account, but instead of the money in the account used to generate interest, it's actually used to save interest against your mortgage. So for example, if you had $50,000 in an offset account and a mortgage of $400,000, you would only pay interest on the difference between the two, which in this case is $350,000. So an offset account essentially gives you a risk-free, tax-free return equal to the interest rate on your mortgage. If you don't have access to an offset account, then you can also do this through a redraw facility. And a redraw facility is basically when you put any extra money directly into your mortgage above your minimum repayment. So let's go back to our example where we had a $400,000 loan. If we put that $50,000 directly into the mortgage, it would reduce the loan amount to $350,000. But because we're $50,000 ahead of our scheduled repayments, we would be able to withdraw that money again. So this essentially has the same effect as the offset account, with the difference being that an offset account makes it a little bit easier to access the money because it's just a standard transaction account, whereas with a redraw, you'd need to transfer the money into a transaction account before you can actually take it out or access it. Now, for most lenders out there, both of these strategies typically only work if you have a variable loan. Most lenders won't allow an offset against a fixed loan. Most lenders won't allow you to put significant extra payments into a fixed loan. And so be very careful if you have a fixed loan before implementing this strategy. you need to understand what the policy of your particular lender is. Now, if you don't have a mortgage, where should you house your emergency fund? Well, unfortunately, your choices are very limited because we have to keep in mind that the number one priority is to keep the funds accessible and keep the funds secure. So that rules out investing, because with investing, you need a minimum of a 5-year time frame before you should invest. You don't have an offset account, you don't have a redraw, so really that's when the old savings account comes back into play. So search the internet for the best savings account, one with the highest interest rate and the lowest fees. Now realistically, there shouldn't be any fees on a savings account, but you got to be careful for the fine print, because some savings account will require you to make regular monthly deposits into it before you get any interest. Other savings accounts will try and get you in on a very good introductory interest rate and then drop off. So just make sure you understand and read the fine print before opening any account. And that's it, guys. Put your emergency fund to use while ensuring that it remains safe and accessible. And thank you for watching. If you've learned something new, give this video a thumbs up and I'll see you in the next one.